Good afternoon, ladies and gentlemen. Welcome to the Painters Hall, and we're going to be having a talk by Andrew Bailey. Andrew is very well known as a man who's a safe pair of hands, and he will certainly need a lot of safety and at least two hands, I would say, in the next few months. Andrew's going to be talking about the monetary policy assessment in the UK. It's a spellbinding set of tables and figures with lots of information and a bit of commentary to go with it. And after that, we will have a question and answer, including with people from the audience. All of this is live streamed. It's all totally on the record, and therefore nobody can put a foot wrong. Everything will go superbly, I'm sure. Over to you, Andrew. Thank you very much for being with us.
Thank you, David. I must begin with a small explanation. My voice is going hoarse. Now, you may all want to leave the room at this point. I can honestly say I've taken several COVID tests today, and I took one an hour ago, and whatever is causing it, it doesn't appear to be that. It's just probably because I've been talking too much. So, apologies, I've got my water, so I hope we'll survive. Well, look, thank you. It's a pleasure to be here and to speak at this event, hosted by ONFIF. Can I also say, I think, in times like these, having independent platforms like the one ONFIF provides, bringing the public and private sector together to discuss issues of great relevance to us and in economic policy is more important than ever. So thank you very much for all the work that ONFIF does. The dominant theme, the predominant theme, I really should say, for central banks around the world currently is the very elevated level of inflation. And sadly, of course, at the Bank of England, it's no exception, with UK CPI inflation reaching 9.1% in May and projected to increase further, we fear, and hope to, well, not hope, we fear, to slightly above 11% by October. In view of continuing signs of robust cost and price pressures, including the current tightness of the labour market and the risk that those measures and those pressures become more persistent, the Bank's Monetary Policy Committee voted to increase bank rate by a further 25 basis points at the latest meeting in June. And that was the fifth increase in rates since last December, taking bank rate to 1.25%. In the minutes of that meeting, the MPC emphasised that it will take the actions necessary to return inflation to the 2% target sustainably in the medium term, in line, of course, with its remit. The scale, pace and timing of any further increases in bank rates will reflect the committee's assessment of the economic outlook and inflationary pressures. And the committee will be particularly alert to indications of more persistent inflationary pressures and will, if necessary, act forcefully in response. And just to sum it up, bringing inflation back down to 2% sustainably is our job. There's no ifs and buts about that. Tonight, I want to step back from the current situation and consider some of the longer-term forces affecting our economy and shaping the economic landscape in which monetary policy is being conducted. Can I have the next slide? Excellent. So let me start by assessing the policy landscape. Monetary policymakers are typically focused on cyclical movements in the economy, since monetary policy is often thought to have its most powerful effect on inflation around about 18 to 24 months ahead. As cyclical shocks hit the economy, monetary policy makers must analyse incoming data to identify the underlying causes and form a view on their implications for the outlook for GDP and inflation. Adjusting policy in response to the cyclical shocks in the foreground of the macroeconomic picture is therefore a core part of our role. In the background of the picture, however, are some slow-moving but important structural changes, such as trends in population and demographics, technological changes like increased automation, and environmental factors like climate change and the transition to net zero. These slow-moving forces may not influence the setting of monetary policy meeting by meeting. That's not what they typically do. But understanding the broader picture and policy landscape is important, because it provides insights into the economic trends that will shape policy decisions in the longer term. As part of this, economists have developed a number of so-called equilibrium concepts that help to summarize key parts of the policy landscape. Of particular relevance for the speech today is the equilibrium real interest rate, which is the hypothetical real interest rate that would sustain output at potential and inflation at target. Now, this concept it's a theoretical variable rather than one we can directly observe. So we have to estimate it, and several approaches have been developed to do so. But it's important to recognize that all of these approaches carry with them a high degree of uncertainty. It means that a concept like the equilibrium real interest rate is typically used to look back on past policy and its stance, or to provide an indication of the general outlook for interest rates over the coming years, not so much a direct guide to policy. That's not what it does. Now, if I go back 4 years to the August 2018 inflation report, the MPC set out its framework for thinking about the equilibrium interest rate. And it's also described in a background paper with bank staff, co-authored, that will be published alongside this speech. That framework decomposes the equilibrium real interest rate, sometimes called R star, into the sum of two components. The first is called the trend real rate, often called uppercase R star for short, driven by long-term structural factors. The second component, no prizes for guessing it's lowercase R star, reflects the effects of cyclical shocks to both aggregate demand and supply, and so can vary substantially over the short to medium term. I'm going to focus this evening on the structural narrative that shapes the policy landscape in the long run. In other words, uppercase R star, the trend rate. And in particular, at its determinants at the global level over the past 60 years or so. Now, for an open economy like the United Kingdom, the trend real rate is pinned down by global forces as capital is free to move around the world. Interest rates would depend on the balance of saving and investment in other countries, as well as the UK. So global R star acts as a long-term anchor for the UK's domestic equilibrium real interest rate. Understanding the relative importance of the different secular factors that drive global R star therefore sheds light on the forces that may ultimately shape the evolution of domestic real interest rates. While our global R star affects the level around which equilibrium real interest rates fluctuate over the longer term, it abstracts from the shorter term cyclical forces at play. This is important because I want to be clear that nothing I say today is a signal about the near-term path of the equilibrium real interest rate in the UK. And therefore, I have to say this, you can't deduce anything from this about what the MPC is going to do at the next meeting or indeed thereafter. Even if the trend global real rate remains low, we may still see a rise in nominal policy rates and equilibrium real interest rates in the short to medium term. So global R star is an underpinning, but it doesn't guide us in terms of policy, meeting to meeting. Now, the second thing I'm going to talk about is that since real interest rates are an important determinant of investment, I will also consider the extent to which investment has responded to movements in the trend real rate. And as I will discuss later on, the determinants of and prospects for investment have important implications for another equilibrium concept that helps us to understand the policy landscape, namely potential output. And that's the hypothetical level of output that could be produced if all resources were fully employed. So we go on to the next slide. We're running ahead. This slide should be chart 1 if I can't quite see them. No, they're skating ahead, I'm afraid. I'll just have a quick look if you don't mind. No, they're cycling on, I'm afraid. That's not chart 1. On the other hand, that might be a hint. There we are, stop there. Right. Phew. So this chart shows the UK 10-year real interest rates, measured directly from index-linked bond prices, plotted to the end of June this year. Two things stand out from this, you can see. The first is that the real interest rate can be quite responsive to cyclical shocks, sometimes moving by a percentage point or more in a matter of months. And you can see on the right-hand side that in the past few months we've seen a relatively sharp and sizable increase. Whether such movements persist depends on the underlying shocks driving real interest rates. If you look, you can see that we saw a similar rise in the 10-year real interest rate after the global financial crisis, but it didn't persist when inflation returned to target. The second observation is that beneath the month-to-month volatility, there appears to have been a fairly steady downward trend since the mid-1980s. Can we go on to the next slide? Yeah. And chart 2 shows that other economies have experienced a similar downward trend in real rates. So this is suggestive of a structural trend in the underlying global trend of real interest rates, in other words, global R-star. Now, this concept can be estimated using a variety of statistical models, all of which extract an underlying slow-moving trend from the more volatile data. Can we go on to the next one? There we are, some different estimates. Some of these estimates from a range of different academic papers are shown here. And the teal line, which I think is the sort of the greenish line, shows a new estimate by Bank of England staff based on data for 31 high-income countries. Now, though there are relatively wide error bands around this type of estimate, and alternative estimates from the literature exhibit different patterns, the direction of travel has been clear, that a decline in global R-star over recent decades is common across economies and across estimates. Now, these sort of estimates help us to understand the dynamics of the trend real rate, but they don't tell us, of course, why it's declined. The dynamics of the trend real rate are determined by slow-moving structural factors that affect the balance between the demand for capital for production and the stock of wealth available to finance it. Understanding the structural trends that drive the balance requires structural models. And that's what Bank of England staff have developed. It's a model of the world economy that brings together several key structural factors that could account for the decline in global R-star. And those factors are productivity growth, population growth, longevity, like for the time we all live, the relative price of capital and government debt. The structural model generates a path for global R-star as well as a decomposition of the contribution of each of these factors. We have the next slide. There we are. And we've got some key results in this table. It includes a baseline model simulation and a range of alternatives that vary some key underlying parameters and assumptions. Focuses on the period since 1985. It ends in 2015 due to the process used to extract the underlying trends and the timeliness of some of the data that are required for the simulation. We think that given the focus on slow-moving structural drivers, omission of the most recent data is unlikely to have a material effect on the estimate of the trend real rate. And I'm going to come on in a bit to consider the more recent period, and particularly the potential impact of the COVID pandemic later in the speech. So this table shows that in the structural model, global R-star falls markedly between 1985 and 2015. The total decline of 1.9 percentage points is driven by the response to the 5 global trends mentioned earlier. And the baseline structural model simulation matches the median change over the same period from the statistical model in the earlier chart, which is in the last row of the table. Though I should stress that both, of course, have substantial uncertainty around them. With respect to the main drivers of the decline, 2 factors, population aging and a slowdown in productivity growth, play the largest roles in explaining the dynamic of global R-star. The productivity growth slowdown across advanced economies has been discussed extensively in existing work. Productivity growth impacts R-star through firms' optimal level of capital for production, in other words, the demand for capital from firms. Lower productivity reduces the potential returns on new investment, the marginal product of capital, and this reduces firms' demand for capital at a given interest rate. and that lowers in equilibrium R star. The model simulation suggests that this effect accounts for almost half of the decline in global R star over this period. Population aging has been driven by a decline in population growth rates relative to the high levels seen following the Second World War, and a marked increase in life expectancy. Importantly, however, in the model, the impact of aging comes almost entirely from the rise in longevity, rather than the decline in population growth rates. Now, what that means is that the effect of population aging on the trend real rate is not a consequence of the so-called baby boomers. I think that's people like me, actually. Instead, it reflects the fact that the oldest generations in the population, including older retirees, also tend to be those who have accumulated the most wealth. This naturally occurs as households accumulate wealth over their working life in order to fund their retirement. This means that a shift in the age distribution towards these cohorts, in other words, population aging, will increase total wealth in the economy. The equilibrium real interest rate falls to incentivize firms to invest this additional wealth into productive capacity. It's important to note that the mechanism is driven by the relative wealth levels of different cohorts within the population. Now, it is true that on average, retirees have low saving rates as they run down their wealth to finance their retirement. But the data also show that in practice, this effect is typically not very strong, so that the average household appears to broadly maintain their wealth during retirement. This tempers the extent to which the retirement of the baby boom generation reverses the impact of aging on the real interest rate. Now, these results imply that the effect of population aging on global R star has been large and is expected to persist. While the powers of the underlying drivers are estimated only until 2015, the model-based simulation implies that the equilibrium real rate will continue to adjust until the population structure and stock of global capital reach an eventual steady state. So importantly, what this model and the data behind it are telling us is that we should not expect that aging and the retirement of baby boomers will lead to significant upward pressure on global R star over coming years or decades. The substantial contribution of population aging to the decline in global R star in the past stems from the steady increase in longevity, and this mechanism tends to lead to permanently lower global R star. But let me be clear. This is not a precise forecast for the level of global R star. There are risks to this assessment, and those lie in other drivers. For example, one potentially important driver, which is absent from the structural model simulation, is the rise in inequality. Existing results tend to suggest that the rise in inequality, as seen in recent decades, puts downward pressure on global R star. Another widespread trend that could push in the opposite direction is the growth in the provision of publicly financed social security and healthcare. It's been argued that this trend would both reduce the incentives for households to accumulate wealth and crowd out private capital, resulting in upward pressure on global R star. I think it's important to note at this point that both inequality and social security provision are, of course, endogenous to other underlying structural forces, including the demographic trends that I've already talked about. I think too often they're talked about sort of exogenous and unlinked variables. I make that point because incorporating these into our narrative requires a fuller consideration of these interactions. Let me now move on to the missing investment puzzle. So can we have the next slide? One of the potential implications, this is one of the potential implications of the past decline in global R star. Standard neoclassical theory, such as that underlying the structural model considered earlier, implies a strong co-movement between the safe real rate and the rate of return on capital. What this means is that we should expect a fall in global R star to be associated with a fall in the return on capital. But while risk-free rates have been falling globally in recent decades, measures of the rate of return on productive capital across high-income economies have not. Can we have the next slide? That may be the one after. As the return on capital has remained stable, that's shown in chart 4, which is not, I think, the one we're looking at. Is it possible to go back one? Sorry, I can't quite see around the corner. Yes, that's the one. Like that. While the safe rate and cost of funding has declined, what that has led to is a wedge that has opened up between the return on firms' investment and the cost of financing it. Can we have the next slide? Yeah, there's the wedge. So what this chart plots is the wedge between the return on capital and the risk-free rates for a broad group of high-income economies since 1990. If the return on capital had co-moved with the risk-free rate, the wedge would have been stable over time. But the wedge has increased in most countries, as shown by the blue swathe. The median increase of around 5 percentage points is broadly similar to the rise in the wedge in the United Kingdom, shown in orange. Now, in standard economic theory, this wedge between the return on firms' investment and the cost of financing it is a measure of firm profitability. And as such, it's a key determinant of investment. So we might expect to have seen an increase in investment activity alongside the recent increase in the wedge. Move on to the next slide. But while the wedge has increased, across the same group of countries, investment has steadily declined, or at best remained stable. And in the UK, shown in orange, the orange line, this decline has been particularly stark since the late 1990s. What this means is that in high-income countries, investment has been low, in spite of a rising wedge between the realised return on capital and funding costs. And this is what I will refer to as the missing investment puzzle. To better understand this puzzle, we conducted analysis using historical national accounts data to study the relationship between investment and the wedge since 1970. The next slide. This chart shows the observed investment rate, the orange line, and its estimated value from its historical relationship with the wedge. That's the blue dashed line. So the increased unexplained gap between the two lines illustrates and quantifies the extent of the puzzle. So what it shows is that UK investment has remained persistently below the levels that would have been predicted from the observed changes in the wedge since the early 2000s. So that begs the key question: what structural factors can account for this? To draw on this, to explore this, I'm going to draw on some new analysis in the accompanying paper using industry-level data for the UK. That analysis considers the role of mismeasurement of capital, as well as the role of competition, financial frictions, and corporate governance. Now, in the existing literature for the United States, the results find little role for changes in competition. Sorry, in contrast with the results for the United States, we find little role for competition. In the US, competition is considered to be an explanatory variable here. Instead, what we find for the UK is that intangible investment plays the most important role. Indeed, there's been a strong trend in the composition of investment by firms, moving away from physical capital, such as buildings and machinery, towards what is called intangible capital, such as research and development, software, databases, and branding. Now, measuring intangible investment is pretty challenging. So although national accounts methodologies are continually improving, existing approaches might be missing part of firms' investment, and that would result in an overestimation of the observed return on capital and, in turn, the wedge. We've been able to partly address this using newly available data covering a broad range of intangible assets, currently not included in national accounts. And we've used these data to construct more comprehensive measures of net investment rates and the wedge between the return on capital and risk-free rates. Can we have the next slide? So adjusting for intangibles by rerunning the analysis on a measure of the wedge constructed using the new data reduces the size of the missing investment puzzle. What this chart shows is that the deviation of the observed investment rate from the rate predicted by its historical relationship with the wedge, the puzzle. The chart compares this deviation when the historical relationship is estimated using two alternative data sources. The orange line shows the case where the unadjusted data are used, and the blue line shows the case when the relationship is estimated using data adjusted for intangibles. And you can see that when the adjusted data are used, the gap is smaller throughout the period and actually almost disappears in recent years. The remaining puzzle is mostly concentrated immediately after the global financial crisis. And so it's possible this is not driven by structural factors, but rather the lingering impact of that crisis, for example, related to sluggish demand recovery and financial frictions. Now, these results suggest an important role for intangibles in the missing investment puzzle, but let me give a few notes of caution. It could be that certain drivers of investment, such as financial frictions, are captured more accurately only at the more granular levels, such as firm-level data. There could be large non-linearities related to the nature of the global financial crisis that cannot be captured in this fairly simple analytical framework. So there's a lot of work still to be done to understand more about this. But let me now come full circle and consider the implications of the findings so far for another important equilibrium concept, potential output. As intangibles seem to be important for the puzzling weakness of investment, can they also help us to rationalize recent developments in productivity and hence the implications for potential output? Since the financial crisis, we've observed a substantial productivity puzzle. Average labour productivity growth in the UK has been around 1.3 percentage points lower since the crisis. While intangibles help to explain the missing investment puzzle, their effect on productivity is mixed, as, if anything, there is evidence that they might be driving this productivity slowdown. Can we have the next slide? Yeah. This chart shows that intangible-intensive industries have experienced the strongest slowdowns in labour productivity growth since the financial crisis. And that's consistent with the recent study by my MPC colleague, Jonathan Haskell. So, unfortunately, there isn't really a consensus yet on what exactly lies behind this observed relationship. A growing literature shows that there are barriers to intangible investment, for example, because intangible assets cannot easily be used as collateral to raise finance. In that case, the tightening of financial conditions following the financial crisis could have disproportionately hindered the development of intangible-intensive industries, with potentially long-run consequences for productivity growth. But intangible investment has recovered in recent years, while productivity growth has remained weak. Could it be, perhaps, that the barriers to intangible investment benefit investment by low productivity firms? Or are other factors at play? Other recent studies have highlighted the impact of the intangible economy on competition. Intangible technologies tend to require large upfront investments, fixed costs in other words. This may give firms with high intangible adoption a competitive advantage and make it difficult for new innovative firms to enter the market. And in that case, entrenched incumbent firms may have fewer incentives to innovate, potentially slowing innovation adoption in the long run. But the UK data don't seem to provide strong evidence in favour of this second mechanism compared to research for the United States. The US literature does report a decline in business dynamism and an increase in market power alongside the rise of intangibles. But business dynamism seems to have been less affected in the UK. For example, firms' entry and exit rates have been stable in the UK since the early 2000s, in contrast to the declining rates observed in the US. So let me finish by just taking stock and looking ahead. Can you have the next slide? I've purposely abstracted from short-run influences on the macroeconomy in order to focus on the longer-term structural trends that have driven the secular decline in global R-star and the puzzling weakness of investment in the UK and other advanced economies. Why do these secular developments matter for central banks? The level of the trend real rate has important implications for the conduct of both monetary and financial policies. In a low interest rate environment, other things equal, monetary policy may find itself more often constrained by the effective lower bound on nominal interest rates. But prolonged periods of low interest rates may also pose financial stability risks via greater risk-taking. Understanding trends in investment is also key, given the importance of investment in driving long-run growth and productivity. And productivity growth is an important determinant of potential output. Estimates of potential output are used to assess the size of the output gap, or the level of spare capacity, which influences the degree of inflationary pressure in the economy. Such estimates can therefore have an important influence on the judgments that inform monetary policy decisions. I've looked at a number of secular trends over recent decades. In the current uncertain environment, it is a challenging time to make predictions about the future. But let me say a few concluding words on what these results might imply for the policy landscape going forwards. The new analysis presented earlier does suggest that the key drivers of global R-star, particularly increasing longevity, are expected to persist. Absent a significant reversal in the key trends that have driven down global R-star, we may expect it to remain low. So it's not unreasonable to expect that global R-star, the long-run anchor for UK equilibrium interest rates, will remain low. Therefore, cyclical adjustments in short-term nominal rates, like those we're currently witnessing, will, for the foreseeable future, continue to be played out against the backdrop of low global equilibrium interest rates. While we have considered several important drivers of global R-star in the past, other factors may come into play over time. You may wonder, for example, whether the pandemic could have impacted some of the key drivers of global R-star, such as productivity growth. Well, I'm afraid the simple and honest answer is that we don't know yet. It's too soon to tell what the long-run impact of the pandemic will be on the economy. These impacts are also difficult to disentangle from the effects of the change in trading arrangements between the United Kingdom and the European Union that may already be weighing on productivity. But it's worth bearing in mind that while the pandemic was a large and unprecedented economic shock, with profound changes to labour markets and the way we work, it's possible that its long-run effects on productivity will be small. The latest ONS estimates of UK labour productivity appear to be in line with pre-pandemic trends. This headline figure, of course, masks several factors at play. There are compositional effects which appear to have raised productivity measures during the pandemic, because the worst hit sectors were also the ones with lowest labour productivity. There were also unprecedented challenges to measuring productivity, including the measurement of hours worked during lockdowns. So the long-run impact of the pandemic on trend productivity growth and hence trend R-star is highly uncertain, though I think plausibly quite small. Another salient emerging risk for global R-star is the impact of climate change and the transition to net zero. Now, neither the size nor the direction of this effect are at all clear. Increased investment by firms looking to adopt the latest green technologies could raise equilibrium interest rates, at least during the transition. But global R-star could be pushed down due to higher volatility and uncertainty, including uncertainty about the transition path towards carbon neutrality. This could lead to higher risk premia and structurally higher levels of precautionary saving by households. So I would simply say that understanding and monitoring these channels is an important task for central banks going forward. With regard to the increasing importance of intangible capital, the new results I reported earlier have showed that this has important implications, not only for how we measure capital, but also for the prospects for potential output and productivity. It suggests that the inclusion of intangibles would lead to an upward revision to the level of GDP. It's worth bearing in mind that something similar happened in 2010 with the inclusion of research and development, R&D that is. But the impact on GDP growth going forwards is more ambiguous and would vary by time period. It will depend on the relative growth of intangible investment. Changing the measure of intangibles would in principle affect both the measurement of output and potential output. So it's not the case that the output gap and hence the stance of monetary policy would differ. Similarly, what matters for the trend real rate, R-star, is how intangibles affect productivity growth in the long run, which is less about data revisions and more about the long-run impact of intangibles. So we really, I'm afraid, have just scratched the surface of this one, and we've, in a sense, these new findings have left us with as many questions as answers. But they are, I think, important. Are there more factors beyond intangibles responsible for the puzzlingly low level of investment? Why was productivity in intangible-intensive industries hit the most by the global financial crisis? And how do these trends differ in the United Kingdom relative to its international counterparts? Further work to answer these questions will have an important implications for the long-run policy implications. The recent sequence of extremely large shocks to the global economy and the implications for inflation and activity clearly make this work both urgent and important. They are the dominant theme for monetary policy deliberations around the world. So, while this analysis does not feed through into the near-term decisions on monetary policy, understanding the structural trends I've discussed today is no less important, and their effects may be felt for decades to come. That's the next slide. Thank you.
Thank you, Andrew, for taking us on a gentle romp through some of the byways of the Bank of England's research. And if that was just scratching the surface, then invite us all back for a 5-hour lecture when you really get into the meat of the issue.
I wasn't going to subject you to that, actually.
But people talk about our star as the lodestar, don't they? Almost a biblical reflection. I'd like to just ask you one or two questions based on what you've had to say, and then we will open this up to the audience, and I'm sure people will be bringing in some near-term aspects as well as some of the more structural questions. But first of all, in one of the slides, I think it was slide number 4, you showed an intriguing little blip at the end of this, what is basically a 35-year bull market in bonds. And I also noticed that it was slightly autobiographical because it started in 1985, which I think is the year when you joined the Bank of England. But I'm sure that was completely coincidental. And don't forget, you're speaking here under the watchful eyes of the future king and no longer the old king, Mervyn. So you can forget Mervyn, just think of the new king. The question is whether this extraordinary fall in the interest rates that we've seen, and you've described all kinds of structural factors for that, whether at least in the last 15 years or so, that was at least partly due to the remarkable amount of quantitative easing that's been going on worldwide, because it was that which really tipped the balance and turned the interest rate in real terms from positive to negative. So would you like to just put quantitative easing into the picture?
Well, as I said at the beginning, I think it's important to bear in mind that global big R star is a structural trend, but it's not a variable that is used to set monetary policy, and therefore it's not directly reflecting monetary policy in that sense. It's if you like, it's the background. So I think when you start to think about quantitative easing, it's important to say not to make that direct link. Quantitative easing is sort of what I would call one of the tools in the kit that can be used to achieve a setting of cyclical policy in that sense. And the thing I would say about quantitative easing is that, lots gets said about quantitative easing, including by us. Certainly in the recent times, I've regarded it in two ways. If you go back to my first week as governor, which was fairly tumultuous.
I thought all your weeks were tumultuous.
Some are more so than others, and the first one was particularly so because I was then actually on Monday the lockdown was declared, and that was the last I saw of some of the staff. And on Wednesday we had a market meltdown, and on Thursday we had an emergency monetary policy committee meeting, and we launched a large QE program. And the reason that's significant is that on that week, on that Wednesday, we were faced with two things. Now, two things that come together. Our two core objectives, monetary policy and financial stability. And both of them, required us to act. Fortunately, the direction of the action was in the same way, because the signs, the signals were all the same. But there was clearly, there was, as well as a monetary policy objective in there was an immediate financial stability objective in there. Going beyond that, when the markets did calm down, it worked in that sense. Obviously other central banks were there as well. My view on it is that it provided an underpinning. It operates somewhat further out along the yield curve than the usual bank rate. And in particular, it provided greater assurance of tying down the cost of borrowing for companies. And that was very important, particularly for those companies that were, not all companies were in the various borrowing.
But you couldn't have too much of a good thing, can't you? And do you not think that now, in the situation we're in now, I know we didn't foresee the accumulation of shocks, including the war in Ukraine, but do you not think that quantitative easing in the UK actually went on for too long? And that extra bout of stimulus that you gave in 2021, where clearly the decision made the year before, could you not have capped that? You'd have had less of a monetary overhang to worry about now.
Well, I think the problem with that, David, is that when you look at the level of GDP in this country relative to the level immediately prior to COVID, as of today, it is only 0.5% higher than it was pre-COVID. And in fact, all of that 0.5 is accounted for by the public sector. The market economy, so-called private sector economy, is no bigger than it was to the end of 2019, immediately prior to the onset of COVID. We've had no growth, effectively, in private sector GDP. We've had very little growth, overall. And so I reject the notion that we've somehow stoked up domestic demand. What we have had, however, so you may say, well, yeah, that's all very nice, but how do you get the inflation? What we have had is a series of very big supply shocks. And I'd point to three of them. One is the supply chain disruptions that we've seen in the world economy. The biggest one now is Russia, Ukraine, the war. The third one is the domestic one, which is the shrinkage of the domestic labour force over the COVID period.
But we do now have core inflation in the UK of around 6%. I know a lot of this has come in from abroad. Your analysis is very well known that. But doesn't that mean that we are in very strong danger of inflationary expectations having seeped in already into the economy? And isn't that the reason why the Monetary Policy Committee has been making all kinds of noises, including from your good self lately, saying we might need to come out with a slightly bigger hammer next time round when it comes to the next interest rate increase, where you will make your deliberations, I know, based on the data on the 4th of
No, indeed. Absolutely, because as I said earlier on, just repeating the language that we used in the statement from the last meeting in June, we made a very clear point that if we observe that inflation appears to be becoming more persistent, and that's important because obviously that is distinguishing what I would call the immediate effects of the external shocks, particularly the immediate effects at the moment of the Russia-Ukraine situation, and particularly the effect on energy prices.
Russia-Ukraine war.
Yes. If we see the effects of those becoming more persistent, and that would come through via domestic price setting and domestic wage setting, then we will act more forcefully. That was the word we used. And that's right. That's right. What I would just, if you don't mind saying, that is not a direct link back to quantitative easing, though.
No, but I want to put that into the overall context, because it seems to me that you are trying to influence expectations. And from your latest data, I seem to remember that wage growth has gone up from about 3.75% on average at the end of February to more like 5.75% now, in May, June. It seems as though wage earners are not paying much attention to your saying it's all going to be all right in the end, it's going to be 2%. They are saying we'd like more money now, thank you very much. And the firms are actually giving them the leeway to do that, because some firms are also making bigger profits in the post-COVID world.
Well, let me say two things on that. One, the national real income shock that we are experiencing from the external shock to import prices is very big. Yeah, we've estimated that on a single year basis, it's bigger than any single year in the 1970s this year. Now, let me just qualify that by saying, but the 1970s, of course, had a series of years, so it's important to bear that in mind, but making a single year point here. And that is a very big effect. We think that will cause domestic demand in the economy to slow because it is shrinking real incomes, and we already, I think, see evidence of that happening. The question mark, which you rightly go to, is that yet feeding through into the labour market and what is happening in the labour market? I think we'd always expect the labour market to be somewhat of a lagging indicator. But I will say two things on that. I mean, I will say that when I spend a lot of time going around the country, talking to businesses, and they are still very focused on the difficulty of hiring people. And of course, we read about it every day in the news, whether it's Heathrow, wherever. And so we are very focused on that point. What I would say, just coming back to the point you made, David, about the earnings numbers, is that it is worth spending a moment just going under the sort of surface of that number for a moment. Because what actually is also happening is that there is a shift in the makeup of that number between permanent pay and one-offs. There is a greater proportion of one-offs. So permanent pay is rising, but it's not rising by the same rate.
So this might be some froth that will blow off relatively quickly.
Well, it might be. So I think it's consistent with what I hear from employers and firms when I go around the country. Many of them saying, we are making one-off payments to compensate for inflation and retain people in a very tight labour market, but we are choosing not to do that through permanent pay increases.
Well, that could be something. I've just got two more questions from me, and then I want to open this up to the audience. I believe there's some travelling microphones as well. One is that in your talk, you talked about an adjustment in interest rates. Some people are talking about tightening, but as you say, interest rates structurally are very low.
Yep.
But we do have still, with the inflation rate that we have, very large negative real interest rates. So it's not really right to talk about tightening at the moment, is it? You might say we ain't seen nothing yet, because you are simply adjusting, you're normalizing, you're correcting. Would you not use the word tightening for what you're doing?
Well, I mean, it's worth looking at the framework I used of the sort of the cyclical movement of rates and the structural long-term movements. And the structural long-term movement, I said, is I think there are good reasons to believe that the forces that have driven this structural long-term trend are not over. Though there's a lot we don't know. On the cyclical trend, obviously, central banks around the world are doing essentially the same thing and adapting for their particular sort of settings. What I think is very important to bear in mind in our case is that we are having this very big shock to national income. Other things equal, we think, and this has been the case in our number of our recent meeting assessments, we think that inflation should come down rapidly next year as those shocks wear off. Now, in the May monetary policy report, however, we said that the risks were on the upside. And so it's important to say, well, what are those risks on the upside? And I would pick two things out, one international and one domestic. I think the international one is overwhelmingly now the situation in Russia, with Russia and gas. I mean, just to give you an illustration of this, I was looking at the other day. Since our May monetary policy report, beginning of May, almost all commodity prices have fallen, with two exceptions, gas and coal. Actually, the oil price has fallen, but the European gas price has gone, and this is particularly the price looking, how the market is pricing the price for this coming winter, is gone much higher.
Yes, well, that's both good and bad news together, isn't it, in a sense?
Well, it's clearly a risk to inflation.
But what you're saying, basically, is that for the time being, you're taking a relatively benign approach, but you're ready to be more severe if need be. You could clearly go a lot higher. Yeah, the market seems to think you'll go to 2.5 or even 3% by, say, the end of next year.
Well, we use the word forcefully in the last statement deliberately because, clearly if we see that evidence of persistence, we will act forcefully, no question about it. We wanted people to understand that, therefore, there are more options on the table than just another 25 basis points. And those options can go both ways.
Just one final point, and then we will go to the audience. And this is about an aspect of the balance sheet that you haven't talked about so far. This is the quantitative tightening. You're doing, what shall we say, passive quantitative tightening, because you're no longer reinvesting the gilts that are redeemed. And you say that you're considering an actual active tightening, i.e. that you start selling gilts, and you may make some decisions on that on the 4th of August. Could you just lift the veil a little bit about that? Because that would mean that you'd be actively selling gilts into a market where interest rates are anyway rising, where we have a lot of confusion about the future direction and the future fiscal strategy of the party of government. I know you don't want to comment on that, but it's quite clear that we are in a vacuum at the moment between different prime ministers. Wouldn't that be the worst possible moment for you to start selling gilts into a market that is already falling as a result of rising interest rates?
Well, we will make an announcement on it on the 4th of August, so we will set out our thinking on the 4th of August. I can assure you of that, because we've said we will do that, and we will do that. Our aim is to make whatever we announce in terms of quantitative easing, I would say, gradual and predictable.
You could tell us now, and that would make it all the more predictable.
I could. I couldn't, because the committee hasn't discussed it yet, so I think that would be a bit of a leap. There are a few more weeks to go yet. But let me say a couple of things on this. I mean, first of all, clearly, and I have said this before, if we went into very stressed markets, we would have an emergency sort of break, if you like, and we would not sell actively into distressed markets. That would make no sense at all.
How do you define distressed markets?
Well, we will come up. I mean, we've got our own internal measures that we use to monitor markets every day, and we will look at those and decide how those fit into that concept. But what I can tell you is, I mean, it's a combination of price movements, bid-ask spreads, market depth, market liquidity. Beyond that, it's important outside those areas to make this active sales program, I think, predictable and gradual. It's important for monetary policy for the following reasons. Bank rates, interest rates are our chosen tool. We do not want to be operating what I might call sort of two discretionary levers. So getting a sort of a predictable path of active sales, means that the market should be able to discount that. But then obviously we can set policy with interest rates to take that into account. And I think that's very important.
Well, all I can say is good luck with that.
Yeah. The second thing is that I am a strong believer that the Bank of England central bank balance sheet should not remain permanently large. I don't think that's a healthy state of affairs. It is a tool that we have at our disposal. It's a tool I hope we don't have to use in the future, but we may. And I think it is appropriate, therefore, to bring it back down over a sensible amount of time to a more steady state level.
Now, you've got quite a long way to go, because it's 900 billion, isn't it, the over amount of bonds, including the corporate bonds?
Well, we have, but let me just add a note of caution there. We don't know what the sustainable equilibrium level of that is, because we don't know what the equilibrium level of demand for reserves is. We have two observation points. One is pre-financial crisis, when the level of reserves was around £30 billion. And the other is today, when, as you say, it's sort of just come under 900. There's an awful long way between 30 and 900.
It's really somewhere in between.
But of course, it is somewhere in between, because the demand for reserves by the banking system has changed. And it's changed quite rightly, because the level pre-financial crisis left us with a banking system that did not have adequate liquid assets. So we can't go back there. How much we go down from where we are today will be interesting. Now, let me say, I believe, best guess, we've got quite a way to go. But we don't know how far.
Well, I would make haste slowly on that if I were you. But Dennis Geep, we've got a question here from Mr. Geep in the audience, who's been waiting very patiently. So, Dennis, if you could set a good standard by standing up so everybody can see you, say your name, speak succinctly, and make it a really good question. I stand up, but I don't know if everyone can still see me.
Dennis Geep, Federated Hermes, and I look after liquidity products. The Bank of England is currently got an open consultation on money market funds. I'm sure, Governor, you appreciate that the UK public sector, higher education, charities, pension funds and corporates use and rely on LVNAV, money market funds, to look after a substantial amount of their cash because of their security, the liquidity, their diversity and the market return. Will the Bank of England assist us in maintaining the current LVNAV model, working with industry on enhancements to ensure that it maintains its prime features, and usefulness to investors in what we appreciate are very difficult times. Thank you.
No, thank you. We certainly will work with the industry. We always aim to do that. I think the goal of having money market funds that can perform, as you said, their role, and that they can do that with assurance of stability in all sort of states of the world, is important. We've had some bad experiences over the last sort of 15 years. But let me be honest. I mean, I'm not pointing to UK money market firms particularly there. This has been an international issue. And our concern, and it's part of our broader global work on non-bank financial intermediation, is that we don't, as we did in the Dash for Cash in March 2020, get into periods where the demand for liquidity, from the demand, in other words, to sell assets into the market, exceeds the capacity of the market-making system to supply it. And, we did see that going on in March 2020. We saw stress going right through to what you might call one of the world's deepest and most liquid markets, the US Treasuries market. And so, we have to look at that, because the central banks, as I was describing earlier, had to step in with very major liquidity support. That is something, from a financial stability perspective, that we should not aim to do as a general matter. We should be much further back in the background than that. But I can assure you, yes, we do want to work with the industry, because I understand that there is a role for money market funds. I'm not, in any sense, wanting to deny that. So we will be keen to work with you to come up with solutions to these issues.
Good. Well, thank you.
It's important that it's done. It's having to be done internationally, because it's a very international industry. Yeah.
Norman Lamont.
Thank you very much for your talk, and I look forward to reading it. I hope we'll get copies. I wanted to ask you about bank independence in the context of QE. As I understand it, the Chancellor Exchequer, I don't have this job myself of doing this, but as I understand it, the Chancellor has to sign the indemnity when QE takes place. The indemnity has never been published, and they refuse to publish it. I know that's not your responsibility, but you might comment on that, why it is a document you cannot obtain. But as I understand it, the Chancellor agrees the overall amount to which the indemnity applies, which means that although individual decisions on interventions in the market through QE are yours, that takes place within an umbrella that the Chancellor has agreed. Has not QE thus transformed independence? Because it's very difficult to believe that the Chancellor Exchequer just signs the indemnity without saying a word or asking you a single question, or in any way wondering what trade-offs you see between the fiscal policy he may be pursuing and the monetary policy that you might or might not pursue. Hasn't QE really, I'm not asking you to give away any state secrets, but I'm puzzled at what the nature of this dialogue between the Chancellor and the Governor, what it could possibly be, without actually him having a considerable influence on you.
It's a very fair question, so let me say two things. You're right, it's not the Bank of England's, within the Bank of England's gift to publish the indemnity. As I think I said to the Treasury Select Committee, I have read it, as you'd expect. It is not a very exciting document, I have to tell you. There's no, in my estimation anyway, there's no sort of, there's nothing in there that would come as a great surprise to anybody in terms of the way it's written. You pose a very good question, and I'll answer it from my own experience, and obviously my own experience is quite substantial in this respect. My own experience is that it is a very mechanical process, an entirely mechanical process. The MPC takes a decision in terms of the stock of QE. By the way, we're doing it in reverse now as well. The same process is working in reverse. A letter goes from me to the Chancellor saying, this decision means the indemnity moves by the following amount, and I get a letter back confirming it. And I've never had any dialogue on the substance of the issue, and that's, I think, my predecessors had the same experience. That's understood. And you know, you're absolutely right to raise the point, because it's a very important point about central bank independence. So there has never, in my experience, been any dialogue which would call into question central bank independence in that respect. Why does it exist? I mean, it exists because if we didn't have it, I think we would either have one of two alternative states of the world. The Bank of England would have to be very heavily capitalised, and that capital is public money, or the Bank of England wouldn't be heavily capitalised, but would be exposed to, to losses, and would have to be recapitalised at the point when, if and when those losses occurred. Now, actually, it's interesting, if you look around different central banks around the world, they've got various different configurations of those options to handle it.
It is a very interesting question, and I presume we have a lot of research on this now, and certainly a lot of questions. Could I just put a question just before the next one, which is about the corporate bond portfolios? This is only 20 billion,
yes.
So what's that? This is not real money, is it? But who's going to pay for the losses on that?
Oh, it's indemnified in the same way.
That is indemnified by the government.
Yeah, but remember, I mean, if you don't mind me saying so, I mean, we've had cash flows going one way since the beginning of the QE programme
So you made some money early on?
Well, but all that's been transferred over to the government. And that was the arrangement that George Osborne and Mervyn King came up with. And we've made no secret. I mean, I think the number that cash flow number that's been paid over is somewhere between 110 and 120 billion pounds.
Yes, so that built a few hospitals.
I've said this before, so I'm not saying anything new here. That, of course, that flow is all to do with the profile of interest rates. And of course, it is most likely that we will run down the stock of QE in a rising interest rate environment, and so the cash flow will reverse.
Yes, yes. Yeah. Well, please, let's have the next question.
Thank you. Alistair Ryan, Bank of America. So you laid out very clearly why the bank feels comfortable.
You could stand up, Alistair, because everybody can then see you. I made an exception for Norman.
You're a youngster, Alistair.
I'm glad. In my 50s now. That's a gift. Thank you.
That's when life is starting.
I haven't asked the question.
You'll always be a youngster, Alistair. So don't worry.
So you've laid out clearly, Governor, why the bank has a framework in which it thinks global interest rates and sort of trend rates in the future will go back down. But it has left you with policy that's quite unusual. So, from your website, 1.25% rates, 9% inflation, you're expecting that to rise further, and it's likely to remain elevated through at least 2023. And then in terms of QE, I mean, it is a huge balance sheet. So Andrew Houser estimated in 2019 bank reserves at 150 to 250 billion as a plausible range. So with the balance sheet at 850, banks haven't changed much since 2019. It'd broadly be the same number. So you have a very, very large surplus of QE.
Could you meander towards a question, please?
Well, so what's the risk? If you're wrong, how do you get back on side? Effectively, you're a long way from shore. If that underpinning it doesn't prove right, if circumstances have changed for whatever reason, how quickly does the bank get back on side with their size of the balance sheet and rates so far short of inflation? Thank you.
Well, I mean, I think Andrew Houser gave that estimate a couple of years ago, wasn't it? I think. I mean, there's uncertainty around that estimate, but I think the best way I would put it is the uncertainty is probably upwards, that the demand for reserves may be higher. But it's still a lot lower than it is today. So we will, if we go ahead with active sales, we will then obviously have an overall targeted reduction, which will be the sum of the active sales and the runoff. And we can obviously estimate, and we will be transparent with the market on this, where we think that is going in terms of the various potential sort of profiles as to where it gets to over a number of years. By the way, the reason that we're having to contemplate active sales is that we're in a different position to the Federal Reserve. We bought in QE in three distinct buckets, short, medium, long, to reflect the UK debt stock. The UK has a much longer maturity debt stock. So the Federal Reserve has got a very, very substantial concentration at the short end. And therefore the decision for them is different. It's not do we do active sales, it's how much are we sort of throttling the runoff, the natural runoff point, I think is a better way of putting it. But we're in a different place to that. The final thing I'd say is that although I think, we all think that we would be quite, a number of years off getting to that point of hitting the equilibrium. And by the way, there's a big question thereafter about what we do about the rest of the stock and how we reconfigure the Bank of England balance sheet, but I won't go to that part. We are clearly going to need to have in place an open market operation tool which we can use to do repo into the markets so that we're covered, if you like, because remember the Fed had this problem a year or two ago. When the market starts to tighten because we're hitting the bottom points, we can alleviate that tightening with an open market operation tool. So we will have that, if we go ahead with all of this, we'll have that in place as well.
Well, thank you. That sounds very intriguing. We're going to have 4 more questions, if I can, and we'll all be quite short because we're overrunning already. Sorry. But first of all, it's James McIntyre. Very quick question, please.
Andrew.
And these will be the last 4 questions.
So, to follow your convention, a lowercase and an uppercase. Lowercase, a very, very quick question is, would tax cuts now mean that you'd need higher interest rates to offset a short-run boost to the economy? And the uppercase question, you didn't mention China. Could the rise of China and massive investment in China sucking investment out of the rest of the world with a fixed exchange rate for much of the period you covered, could that have some explanatory power?
I'm afraid I'm not going to answer your first question. There were various attempts in the Treasury Select Committee in Parliament yesterday to ask me this question.
You withstood them all very well.
All of which came from it was the Labour members who were goading me to sort of, and it's not for me to enter into that debate. On China, it's interesting because, of course, there was a period when China was a net supplier of saving into the world. So you're right, of course, that in the global R-star, China is a factor in that consideration. Yeah.
So we have Trevor here. Do you have a microphone yet, Trevor? And then there's just 2 ladies on either side of you, or on the other side of you afterwards. And then we're going to have to close, I'm afraid.
So Trevor Greetham at Royal London. Following up on the question about bank independence and inflation targeting, do you think more can be done to convince the general public and politicians about the benefits of Bank of England independence and about inflation targeting? Because it strikes me that because of that long period of falling real interest rates you referred to, recessions have been very rare. Most people haven't lived through very many. And during the time of bank independence, one was blamed on the bankers and the other one on COVID.
You're not looking for a job on the MPC, are you, Trevor?
And, maybe in a few years' time, but right now, no, thank you.
I think look, I'll be quite simple about this. I think overwhelmingly the most important demonstration of Bank of England independence is that we return inflation to target. It's the biggest test of the system. As I said earlier, no ifs and buts, and that's the biggest test. And I'm very clear with people. If we don't get inflation back to target, things get worse. So we've got to get inflation back to target, and we will do it.
Catherine.
Hi, Kathleen Tyson, Pacemaker Global. Going back to something you spoke to briefly a few minutes ago, Sultan Pozar, who was the head of the open market desk at the New York Fed, suggested in 2019 that the obsession with R-star was distracting from the much bigger fight to combat the decline in market liquidity in wholesale markets. Then in September 2019, there was a repo market failure, an overnight repo. The Fed intervened. That was followed by the market makers in the United States and the mid-tier market makers suggesting that there were structural failures in the structure of the U.S. Treasury market, including the increasing dominance and concentration in the top 4 dealers, which the BIS has also expressed concern about, and CCP clearing being skewed to increasing the burden of the clearing costs on anyone except the top 4. Now, we know the Fed is looking at these things, but obviously when the Treasury market failed in March 2020, it communicated within seconds instability globally to every fixed income market, and there are 400 of them that price off of US Treasuries. So that meant central banks everywhere in the world had to intervene. It triggered panic globally. I'd like to think that part of fixing that problem would be reviewing the 20 years of IOSCO and BIS market regulation that has undermined global wholesale liquidity, and that if we are going to have Brexit, which I did not vote for, that we could use it to reassert UK's dominance in global wholesale trading, which was 90%.
Statement. So are you asking Andrew whether he agrees with you
can
or
we
not?
consider market structure in parallel with our star?
Oh, absolutely. I don't think there's a trade-off between market structure and R-star. I think they're sort of different worlds in that sense. There's a very large program of work in the Financial Stability Board, Supervision and Regulation Committee, of which I have the pleasure of chairing, which is addressed at a number of aspects of that issue about demand for liquidity. So we were talking about money market funds earlier. There's work on open-ended funds, reviewing the IOSCO, the IOSCO principles on open-ended funds. And there's a whole set of issues, and you're right, Kathleen, about the US Treasury market. I think it's not for us at the Bank of England to say, how it should be organised, but I think the question about, the resilience of these markets, where I would disagree with you more is on the question of, is the problem with the Basel Committee in terms of the supply of market-making capacity? I'm not convinced on that front, for a number of reasons. One is, I'm afraid the post-global financial crisis reforms, of course, were a response to some even worse things that we saw happening then. Secondly, I do think there's a bit of an assumption that, two ways I've heard it put. One is the job of banks is to sort of catch the falling knife. And secondly, I don't think in that situation you can think that banks will operate a regime where, as one market maker put it to me, now's the time for me to bring my losses round and deliver them to you. That's just not going to happen in this world. So I think more of the attention really has to be on the demand for liquidity side and how that non-bank world works. And of course, it is important to have a final point I'll make on this because, of course, and this is not surprising, the balance of global financial intermediation post the global financial crisis has shifted from the bank to the non-bank world, which of course was a product of in one sense, of the reforms to the banking world.
And now we're going to have the final question.
Thank you for the speech, Sonali Punhani from Credit Suisse. So compared to the Federal Reserve, the Bank of England has taken a much more gradual approach to raising rates. So do you think there are differences in the inflationary drivers between, say, the US and the UK, which has led the BOE to have a more gradual approach while the Fed is being more aggressive? And just to follow up, you said that you would take forceful action if there are signs of persistence of inflation. What would sort of trigger that? Aren't we sort of already seeing persistent domestic inflation in the UK?
Well, let me start. The first question is probably easier to answer. I think it's important to bear in mind that the shocks that, if you take the Bank of England, the Federal Reserve and the ECB are facing are different. In fact, they're sort of almost like overlapping the sort of circles. The US has more of a demand shock element to it. So the US has more of a sort of inflation and demand going up. I think I gave the figure earlier for when David was asking me for, GDP in this country on the latest figure was 0.5% higher than pre-COVID. I think the equivalent figure for the US is 2.8. So it is a different situation. So the Federal Reserve is facing a different configuration of shock to the one that we are. What we have in common with the US is the labour market shock. What we have in common with the ECB is that we're both facing this terms of trade shock, particularly now from energy prices and from the Russian war. But our labour market shock is more like the US than the ECB. So I think when I think about it, if you think about the different responses of central banks, it's important to have that sort of framework in mind, I think, when thinking about what we're doing. It doesn't tell you what we're going to do meeting by meeting, but I think it's an important sort of framework to have in mind.
Thank you, Andrew. You've ended up with the word framework, and I think that's a very good place to be, because you've actually given us a good insight into what you might call your reaction function, you and the other colleagues on the Monetary Policy Committee, and you've done this with your customary patience and good cheer and a certain amount of aplomb, despite the fact that your voice, at the beginning, was fairly ropey, but your voice has got better in the course of this conversation, I would say. And I pick up, actually, an element of the rather granular, gravelly nature of an Alan Greenspan there, mixed with the exquisite good humour and patience of a Jens Weidmann. I see that in both of your delivery, but particularly Greenspan, without the American accent. Thank you very much indeed for your time.